I'm going to go over all of the things that you need to know about individual securities for your Series 6 exam. So how do corporations finance growth? A corporation can raise money or finance growth through the issuance of common stock. There's no such thing as a corporation that hasn't issued common stock, preferred stock, and bonds. When an investor purchases into common or preferred stock, they're considered an owner of the company. Investors that purchase into debt are considered lenders. A bond always represents a loan. Let's take a look at some of the common stock features. While the ownership for a common share is referred to as a stock or a share of stock, par value on common stock is an arbitrary number used to set up the books. We're more concerned with market value. The market value for a common stock is the price that the stock trades at in the market. Common shares have the right to vote, where preferred shares do not, and the right to vote for the board of directors, either in cumulative or statutory voting, inspecting books and records, transferring ownership, and maintaining their same interest in the company when they go and issue new shares, and that's your preemptive right, as well as the right to receive dividends if declared by the board of directors. Preferred stock is considered a senior security and has a preference over common stock in two areas: dividends and bankruptcy. Preferred stock has a stated value, a par value of $100. On your exam, par value will always be $100 unless they tell you otherwise. The dividend is fixed as a percentage of par value on an annual basis, and it never changes. So the dividend is stated as an annual percentage of par value. For the preferential status over common stock that the preferred stock has, preferred stock gives up the right to vote. One of the main risks associated with preferred stock is interest rate risk. How a general decline in interest rates or an increase in interest rates would affect our securities price. If interest rates in the market go down, we'd anticipate that the price on preferred stocks would go up. If we see that the interest rates are going up, the price on preferred stock would be going down. They're interest rate sensitive, just like debt instruments, and they have an inverse relationship with interest rates in its price. When comparing interest rates to the price, they have an inverse relationship. What are some preferred stock features? Cumulative preferred stock means all back dividends plus the current year dividends must be paid to the investor before common stockholders may receive a dividend. Callable preferred stock gives the issuer control. It allows the issuer to call the issuer or the stock away from the investor when normally stock trades in the market forever. With callable preferred stock, the issuer has all of the control. They can take it away from you. And that's very unique because, like with other stocks, preferred shares should trade out in the market forever. So with callable preferred, the issuer maintains the control and can require the investor to liquidate early. Thus, callable securities provide the investor with a time frame in which their security is non-callable. And we call that call protection, a set period of time where the issuer cannot call the security, and or they offer a call premium. That means if the stock is called early, the issuer will pay the investor a slightly higher amount over par value. A convertible preferred stock is convertible into common stock at the same issuing company. The conversion price is par value divided by the conversion ratio, and the conversion ratio is par value divided by the current conversion price. Participating preferred stock, we have a fixed dividend, but we can get an extra dividend or more money if the board of directors declares it. With participating preferred stock, the dividend is always set at a minimum amount, but not a maximum amount. Now, let's go ahead and look at debt instruments. So, what is a bond? A bond is a debt instrument. It's an IOU. It's a promise to pay or a loan. The par value for all bonds on your test, unless the exam states otherwise, is $1,000. You may see on your exam an abbreviated Latin symbol, such as the letter M. If you see a customer owns 1M ABC debenture, well, that simply means the test is asking you about one bond with an M being Latin for $1,000 face value. Little known trick within the securities industry. If the test asks you about 5M, so a question owns 5M or 5 $1,000 bonds, that just means that the test is asking you about the equivalent of 5 bonds. So do the math and then multiply at the end. So unless the test states otherwise, the par value is $1,000. And interest is called the coupon or the nominal yield. And the nominal yield is stated annually, but paid out semi-annually, and it is a fixed rate of par value of the nominal yield. That means it never changes. Interest is called the coupon or the nominal yield, and that nominal yield is stated annually, although it's paid out semi-annually or twice per year. It is also a fixed rate and it never changes. It's stated on the bond, it's a fixed rate, it never changes, the coupon or nominal yield. I want to take a second to go through the three major bond yields as a refresher from the SIE exam. Let's take a look at the nominal yield. Let's take a look at bond yields. We have the nominal yield, the current yield, and the yield to maturity. The nominal yield is referred to as the NY, or coupon, or the coupon rate. This is the fixed interest rate on the loan. So the nominal yield is based on an annual percentage of par value, but it is paid out semi-annually. It is fixed at issuance. The current yield measures an investor's real return based upon the dollars that they invested. It's abbreviated as CY, and it is considered the market price of the bond. And it does consider the market price for the bond. So to figure out the current yield, we take the annual interest in dollars and divide it by the current market price of the bond to figure out what that investor's real return is. So current yield equals interest divided by current market price, stocks div divided by current market price, and finally we look at yield to maturity, or we call yield to maturity basis. So the yield to maturity is a huge assumption because it takes into consideration the market price for the bond, the capital gain or capital loss if you bought it at a different price than par value. If we hold it to maturity, we're investing all the coupons into a similar bond in the market with similar credit quality that pays a similar coupon. And then we also take into consideration the time value of money. So again, the yield to maturity is a huge assumption. One of the main risks associated with debt is credit risk or default risk. This is the risk that an issuer will miss interest and/or principal payments, the eventual repayment of principal. We have three main credit rating agencies. We have Moody's, Standard & Poor's, and Fitch Ratings. I assume that your test is going to mention Moody's and S&P ratings. So let's take a look at long-term bond ratings for Moody's and Standard & Poor's. With a long-term bond, we have credit risk. So both Moody's and the S&P assess credit risk on debt instruments, just like our credit reports with Experian, Equifax, and TransUnion. These ratings by Moody's and S&P give the general investing public a good idea about what the credit quality of the issuer is. So these credit ratings are very important. So for example, Moody's and S&P, they rank down from the highest rating, which is AAA, to the very lowest rating, which is C. All of the debt here that is considered investment grade are called high quality debt. The higher the quality, the lower the coupon because there's less investment risk. So with speculative bonds, these are also referred to as junk, or my personal favorite, high yield bonds. I have a high yield investment for you. It sounds really good, but it's a whole bunch of junk. So the lowest rating bond is a C-rated bond, and that would be what I'd call the junkiest of the junk bonds. That means the C-rated bond is the most aggressive out of all ratings between Moody's and S&P. How do I distinguish the difference between the S&P and Moody's rating because they're both AAA or all the different letters? Here's how I remember that. Moody's is a capital letter followed by vowels that are lowercase. So always assume for Moody's you're going to have a capital letter at the beginning followed by two lowercase vowels or one lowercase value. And you also notice that Moody's is spelled that way. And then with S&P, the S&P is always in capital letters. So S&P is always going to be capital letters followed by capital letters. And that's how I've always remembered this since I've taken this exam. It's a good way to remember it, embed it into your memory. And then once bond risk, the second besides credit risk is something known as interest rate risk. The interest rate risk is the risk that interest rates are going to change, causing the bond's price to either go up or down based upon how the interest rates. Our main concern is that with rising interest rates, our bond's price is going to fall. So interest rate risk is the greatest for long-term maturity bonds that has very low coupons. On the test, you're looking for a maturity of long and low to be the most risky. This interest rate risk with the price of the secure in the market, this relationship is an inverse relationship between current interest rates and existing bond prices. So if interest rates go down, my existing bond price will go up. If current interest rates go up, your existing bond price will go down. So let's take a look at our different issuers of debt. First, we have corporations. A corporation can issue either secured debt or unsecured debt. Secured debt will always be backed by something tangible. We can sell to pay off the debt if needed to. Secured corporate bonds include a mortgage bond backed by real property, an equipment trust certificate typically issued by railroads and airlines, large transportation companies. They're backed by their equipment, like for example, with an airline, historically they've been proven to be very secure because the company can't do business without the equipment. And then a collateral trust certificate. This is issued for the benefit of the subsidiary, but the parent company's stock is what we use as collateral to back the debt. Then we have unsecured bonds or unsecured debt, like a debenture. Unsecured debt is solely backed by the goodwill and good faith of the parent company. So some of our unsecured bonds are traditional debentures. That's just the fancy word for an unsecured bond. You'll definitely see the word debenture come up on your exam. A convertible bond, similar to convertible stock, where we take our bond and convert it into a fixed number of common shares. And then finally, a zero coupon bond. A zero coupon bond is always issued at a discount, and it creates taxable phantom income for the investor. That phantom income is that straight line amortization upward, known as accretion. Let's now talk about U.S. government, known as agency debt. So U.S. government debt that we'll see on our exam includes negotiable U.S. debt instruments. So T-bonds that are long-term, Treasury notes are intermediate term, and T-bills are short-term, maturing in 1 year or less, not less than a year. The reason why these securities become very important for older investors is due to their high degree of safety, because it's backed by the full faith credit and taxing power of the United States government, which is why the U.S. government is the largest and safest issuer of debt in the world. It's never defeated on a loan. Agency debt is sponsored by the U.S. government for Fannie Mae and Freddie Mac, but for Ginnie Mae, Ginnie Mae itself is the Government National Mortgage Association. It's part of our Housing and Urban Development Division of the U.S. government. So with a Ginnie Mae, they've packaged all these different mortgages that are very high quality together, and then they create a pass-through certificate for investors to purchase into. Those pass-through certificates do pay out monthly income, and they are backed by the full faith credit and taxing power of the United States government. They're made in both part interest, part principal, because people pay their interest and principal monthly on mortgages. Note that Fannie Mae and Freddie Mac are not backed by the government, but they're just sponsored by it. They both went into government conservatorship after the Great Mortgage debacle in early 2000s, 2008, 2009 timeframe, but they are not part of government. We also see municipal debt. Municipal debt is broken into two main categories: general obligation bonds, or GOs, such as things that would be used like a school, and revenue bonds. A general obligation bond is backed by some type of taxation, and interest income is exempt from federal taxation. So what kind of taxes do we use to back a GO bond? We use state income tax or state-funded debt, and we use local property tax for what we call ad valorem tax to fund local municipality debt, like your city, your school district, your town, your county. You're assessed the taxes to pay for the municipal improvements. With the revenue bonds, these are backed by user fees. So interest income for investors is still exempt on the federal level. But now what backs the debt is different. We use user fees like tolls, concessions, parking fees. The last thing that I really want to go through quickly in this chapter with you is money market debt. Money market debt is always invested. People invest in money markets. They invest in them for capital preservation and liquidity. Short-term debt. We consider money market short-term debt things like treasury bills. They mature in a year or less. They're a zero coupon. Commercial paper. which is high quality corporate debt that matures in 270 days or less, and then a negotiable CD. If you've ever worked in the banking sector, we call these jumbo CDs. Whether or not they're negotiable, because as a bank we have to call to a trust department to get that rate of return. Negotiable CDs are also interesting because they have a $100,000 par value. And then we also have tax-free short-term debt in the way of anticipation notes, so RANs, TANs, TRANs, GANs, CLNs. These are all short-term municipal debt instruments. So for example, a RAN is a revenue anticipation note. So the municipality is anticipating revenues to be generated to pay off the debt. That is it, you guys, for this section of Chapter 1. Don't forget to go over to millionairesintraining.com, do a light review, take your practice questions, and review your explanations as you go through the test. Do a live review of a final exam, and then take your final exam quiz. I look forward to coming back in Chapter 2, talking to you guys about all things investment companies. I'm Colin Kleck, representing millionairesintraining.com, our custom business development and securities licensing exam system. We look forward to seeing you in the next video.